The European Union believed it had executed a decisive move. In what officials framed as a bold act of economic punishment, EU leaders confiscated roughly $15 billion in Russian state assets that had been frozen since the start of the Ukraine war. The funds were redirected to Ukraine as reconstruction assistance, compensation, and a signal of Western resolve. The intention was clear: deter Moscow, reinforce unity, and prove that aggression carries consequences. Instead, the decision unleashed a response from Russia that European governments now privately admit they failed to anticipate. Russia did not retaliate militarily. There were no cyber offensives, no sudden shutdown of remaining energy flows. Instead, Moscow struck at something far more sensitive. It reshaped key rules of global finance, triggering consequences that may burden Europe for decades. What follows is not only a Russia-Ukraine story. It marks a turning point in the post-World War II financial system and highlights Europe's role in undermining its own economic foundations. To understand the fallout, it's necessary to revisit what the EU actually did. Following Russia's invasion in February 2022, Western governments froze nearly $300 billion in Russian central bank reserves held in European and American institutions. The scale was unprecedented. Never before had a major power's sovereign reserves been immobilized to this extent. The legal basis was controversial. These assets did not belong to sanctioned individuals or private entities, but to a national central bank. For 2 years, the reserves remained frozen. Russia repeatedly demanded their release. The West refused, yet outright confiscation posed serious legal obstacles. European legal experts warned that seizing sovereign reserves would violate international norms, erode confidence in central bank asset protection, and set a dangerous precedent. Political leaders pushed ahead regardless. In November 2025, the European Council approved the transfer of $15 billion from the frozen reserves into a Ukraine reconstruction fund. The legal rationale was improvised. The assets were reclassified as compensation for Russian aggression. EU leaders celebrated the move as a moral victory. Media outlets echoed the praise. Politicians rushed to claim ownership of the decision. Moscow's initial reaction appeared restrained. A handful of sharp statements, warnings of retaliation, and diplomatic protests followed. Western commentators dismissed them as empty threats. Russia, already sanctioned and excluded from Western markets, seemed to have little left to lose. This assumption proved to be Europe's most serious error. Russia's counterstrike unfolded in 3 phases, each more consequential than the last. The first came swiftly. Within 2 days, Moscow announced the takeover of all European-owned corporate assets inside Russia. BP's multi-billion-dollar stake in Rosneft was absorbed by the state. Shell's operations were seized. Total Energy's projects were nationalized. Société Générale's banking business was taken over. German car manufacturers lost factories operated by Volkswagen, BMW, and Mercedes. Pharmaceutical plants, food processors, retail chains, infrastructure projects, and intellectual property were all transferred to Russian control. The combined value exceeded $120 billion, many times what Europe had confiscated. European executives panicked. Markets reacted violently. Share prices plunged. Insurers faced massive claims. What had seemed symbolic suddenly became financially devastating. The second phase targeted energy, but with a calculated twist. Russia announced that any remaining oil and gas exports to Europe would only be sold in rubles or yuan. Euros would no longer be accepted. Unlike earlier threats, Moscow did not reduce supply. Instead, it altered the payment framework. European buyers now had to acquire Russian or Chinese currency, often via intermediaries, absorbing higher transaction costs, currency volatility, and reduced transparency. The broader impact was systemic. By rejecting the euro, Russia sent a clear signal. Europe's currency was no longer universally acceptable. Energy-importing countries were forced to sell euros to purchase rubles or yuan. The euro weakened under sustained selling pressure. The ruble strengthened, defying years of sanctions narratives. China emerged as a major beneficiary as yuan-denominated transactions accelerated. The European Central Bank watched as currency depreciation imported inflation into the eurozone. The third phase stunned policymakers. Russia announced the formation of a BRICS Plus reserve fund, capitalized at $150 billion by Russia, China, India, Saudi Arabia, the UAE, and other states increasingly uneasy about Western financial coercion. The fund's mission was to provide liquidity and protection to countries facing sanctions or asset freezes, effectively an alternative to the IMF for the politically exposed. Its true innovation lay in asset custody. Sovereign reserves deposited with the fund would be distributed across multiple non-Western jurisdictions, making unilateral seizure impossible. China committed $50 billion, Russia pledged $30 billion, Saudi Arabia and the UAE added $25 billion each. India, Iran and others contributed the remainder. The message was unmistakable. A parallel financial infrastructure was now operational. Countries around the world took notice. If Russian reserves could be confiscated in Europe, whose assets were truly safe? Capital began shifting. Gulf states reduced exposure to European bonds. Asian central banks accelerated diversification. Even neutral countries began reassessing reserve allocations. Trillions were at stake. A modest reallocation translated into hundreds of billions in selling pressure. European bond yields rose as demand softened. Governments faced higher borrowing costs precisely as fiscal needs expanded. The ECB was trapped between defending bond markets and containing inflation. Its half measures calmed markets temporarily, but failed to restore confidence. Germany bore the brunt. Its manufacturers had deep roots in Russia. Automotive losses alone reached tens of billions. Factories that took decades to build vanished overnight. Political backlash followed. Business groups demanded compensation. The government, having endorsed the EU decision, had no viable response. France faced parallel turmoil. Energy firms absorbed massive write-downs. Banking losses mounted. Italian, Spanish, Dutch and Scandinavian companies reported seizures across sectors. No major European economy escaped unscathed. Energy dependence fractured EU unity. Hungary adapted quickly, accepting ruble payments and maintaining supply. Other countries faced a dilemma: ideological purity or affordable energy. The divide widened along geographic and economic lines, eroding the bloc's cohesion. More damaging than the immediate losses was the precedent. Central banks exist to preserve safety. If assets in Europe could be confiscated for political reasons, holding them became a liability. Diversification away from European custody accelerated. Ironically, jurisdictions once viewed as riskier, such as China, began to appear safer. For decades, Europe thrived as a neutral financial haven. That reputation rested on trust. The seizure shattered it. The euro's global reserve role weakened further. China capitalized on the moment, expanding yuan-based systems and presenting itself as a defender of sovereign financial rights. Legal challenges followed. Russia filed cases across international courts. While unlikely to recover the funds, Moscow aimed to document precedent, reinforcing the notion that international finance now bends to power rather than law. That instability harms capital-rich regions more than those already marginalized. Privately, European officials now concede miscalculation. Publicly, they cannot reverse course. The result is paralysis. Capital continues to drift away. Costs compound. Ukraine received essential funding, but Europe absorbed losses many times greater. Looking ahead, higher bond yields alone may cost European governments hundreds of billions over the next decade. Currency depreciation fuels inflation. Corporate write-downs suppress growth and employment. Political backlash intensifies. Russia, meanwhile, has adjusted, pivoting east, replacing Western firms, and integrating into alternative systems. History offers parallels. Harsh post-World War I reparations weakened Germany and destabilized Europe for decades. What seemed punitive proved counterproductive. The same pattern is emerging. The seizure of Russian assets fractured trust in global finance. Once broken, it cannot be easily repaired. Europe chose immediacy over strategy. The consequences will define the next generation of global economic alignment. What makes this episode especially damaging is that it signals a permanent shift in how power is exercised in global economics. Financial influence once relied on credibility, predictability, and restraint. Europe benefited enormously from this system without needing to dominate it overtly. By crossing the line from freezing assets to actively reallocating them, European leaders demonstrated that access to Western financial infrastructure is conditional, not neutral. That realization will shape decision-making in capitals far beyond Moscow. Going forward, countries will not wait for conflict before acting. They will preemptively structure reserves, trade flows, and investments to minimize exposure to Western jurisdictions. This means more bilateral trade agreements outside the euro system, more commodity pricing in non-European currencies, and greater use of regional payment networks. These changes will not make headlines overnight, but they will steadily erode Europe's influence in global finance. The shift will also affect Europe's own strategic autonomy. As foreign capital becomes more cautious, European governments will rely increasingly on domestic savings and central bank support. This reduces fiscal flexibility and increases political tension between northern and southern member states over debt, inflation, and monetary policy. The Eurozone's internal fault lines, never fully resolved since the sovereign debt crisis, will widen again under these pressures. At the same time, Europe's leverage over future conflicts has weakened. Asset freezes once worked because they were seen as reversible tools of diplomacy. Confiscation removes that incentive. If assets can be taken regardless of outcomes, adversaries have no reason to negotiate for their return. This hardens positions, prolongs conflicts, and reduces Europe's ability to shape settlements. Perhaps the most enduring damage is reputational. Global finance runs on confidence more than rules. Once investors believe that rules can be rewritten under political stress, they price that risk permanently. Europe may continue to attract capital, but it will do so at a higher cost and with diminished trust. In attempting to demonstrate strength, Europe revealed vulnerability. The decision may stand politically, but strategically it altered the balance of financial power in ways that cannot be undone. History offers parallels. Harsh post-World War I reparations weakened Germany and destabilized Europe for decades. What seemed punitive proved counterproductive. The same pattern is emerging. The seizure of Russian assets fractured trust in global finance. Once broken, it cannot be easily repaired. Europe chose immediacy over strategy. The consequences will define the next generation of global economic alignment.